Diversification beyond traditional assets. The conventional wisdom of diversification, often preached in financial circles, typically centers on a balanced mix of public stocks and bonds. While this approach offers a degree of stability for maintaining existing wealth, it rarely serves as the engine for exponential growth required to transcend into the ultra-high net worth bracket. For those aspiring to reach the 100 mark, simply spreading capital across various sectors of the S&P 500 or allocating a fixed percentage to government bonds represents a strategy of incrementalism, not transformation. Such traditional models are designed to mitigate risk within a well-understood, liquid framework, but they inherently limit the potential for the truly outsized returns necessary for generational wealth creation. To achieve what the vast majority do not, one must diverge from what the vast majority do, especially concerning portfolio construction. Relying solely on publicly traded instruments, no matter how diversified within that universe, essentially caps your growth potential at market averages, which are insufficient for our ambitious target. This realization forms the bedrock of a sophisticated wealth-building strategy, demanding a reevaluation of what diversification truly means at the highest echelons. The inherent characteristics of traditional assets, such as their high correlation during market downturns and their public market efficiency, often prevent them from delivering the alpha needed to accelerate wealth accumulation dramatically. When economic tides turn, the supposed insulation offered by a 60-40 portfolio frequently evaporates, as both equity and fixed income markets can experience simultaneous pressures. Moreover, the transparency and liquidity of public markets mean that information is rapidly priced in, leaving little room for a significant informational edge or the capture of substantial mispricing opportunities. While these assets offer ease of entry and exit, this very liquidity can be a double-edged sword, making them susceptible to short-term volatility and often failing to reward patient, long-term capital with a premium. For those aiming to multiply their capital significantly, merely participating in these efficient markets means accepting their inherent limitations, a constraint the ultra-wealthy actively circumvent. True wealth architects understand that the blueprint for extraordinary financial success extends far beyond the familiar confines of public markets and into the realm of alternative assets. These distinct investment vehicles form the bedrock of ultra-high net worth portfolios, offering a crucial pathway to uncorrelated returns and access to opportunities unavailable to the average investor. Rather than simply hedging against market downturns, these alternatives are designed to generate substantial, independent returns that can propel a portfolio forward even when traditional markets stagnate or decline. Embracing this expanded universe of assets represents a pivotal shift from merely preserving capital to actively constructing a robust engine for wealth multiplication. It demands a more sophisticated understanding of risk, illiquidity, and the unique dynamics that govern these specialized markets. The allure of these alternative investments stems from several key advantages, most notably their potential for genuine diversification through low or negative correlation with traditional asset classes. Unlike stocks and bonds that often move in lockstep during periods of stress, a well-chosen allocation to alternatives can provide a much-needed ballast, smoothing overall portfolio volatility while enhancing returns. Furthermore, these assets frequently offer an illiquidity premium, compensating investors for tying up their capital over longer horizons with the promise of higher potential yields. This premium is a direct reward for accepting the reduced flexibility that comes with private market investments, a trade-off that sophisticated investors are more than willing to make for superior long-term performance. Access to unique proprietary deals and specialized expertise further distinguishes these opportunities, offering a competitive edge that is simply unattainable in the hyper-efficient public arena. The landscape of alternative assets is vast and varied, but for the purposes of achieving ultra-high net worth, certain categories stand out as particularly potent. Private equity, for instance, involves direct investment into private companies, often with a hands-on approach to value creation that public market investors rarely experience. Venture capital, a specialized subset of private equity, focuses on funding high-growth startups with the potential for disruptive innovation and exponential returns, albeit with higher risk. Real estate, in its various forms beyond publicly traded REITs, offers tangible assets with income-generating potential and appreciation driven by specific market dynamics, often providing a hedge against inflation. These are not merely supplementary investments. They are foundational pillars in the portfolios of those who have successfully navigated the path to significant wealth, each offering distinct mechanisms for growth and diversification that traditional assets cannot replicate. This strategic pivot towards alternative assets demands more than just capital. It necessitates a fundamental shift in mindset. You must move beyond the quarterly reporting cycles and daily market fluctuations that dominate public markets, embracing a longer-term perspective rooted in fundamental value creation. It's about becoming an owner, not just a shareholder, and understanding that real wealth is often built through active participation and strategic influence rather than passive observation. The patience required to see these investments mature, often over several years, is a stark contrast to the instant gratification sought by many in the public domain. Cultivating this disciplined, long-term vision is paramount, allowing you to ride out interim volatilities and fully capitalize on the compounding power inherent in these less liquid, yet potentially more rewarding ventures. A significant barrier to entry for many investors is the exclusive nature of these alternative opportunities, often reserved for accredited investors, qualified purchasers, or large institutional funds. This exclusivity is not arbitrary. It stems from regulatory requirements designed to protect less sophisticated investors from the inherent complexities and illiquidity of private markets. However, for those who meet the criteria, this barrier becomes an advantage, limiting competition and allowing for the pursuit of alpha that is not quickly arbitraged away by the masses. Understanding these access points, whether through specialized funds, direct co-investments, or strategic partnerships, is crucial for unlocking the next level of wealth creation. It means actively seeking out the invitations to tables where the real deals are discussed, rather than waiting for opportunities to appear on public exchanges. Investing in alternative assets is far from a passive endeavor. It requires rigorous due diligence, specialized expertise, and an unwavering commitment to understanding the underlying mechanics of each investment. Unlike buying a publicly traded stock with readily available financial reports and analyst coverage, assessing a private equity deal or a venture capital opportunity demands deep dives into business models, management teams, market dynamics, and exit strategies. This is where the true value of an investor's network and analytical capabilities comes into play, as proprietary insights and access to unvarnished information can make all the difference. Without a robust framework for evaluation and ongoing oversight, even the most promising alternative can become a significant capital sink, underscoring the need for informed strategic engagement. These unique assets present a different risk-reward calculus compared to their traditional counterparts. While they often carry higher individual risk due to illiquidity and concentration, the potential for outsized returns can significantly rebalance the overall portfolio equation. The longer lockup periods, often stretching 5 to 10 years or more, mean that capital is committed for extended durations, foregoing the ability to quickly reallocate based on short-term market shifts. However, this very illiquidity is often what creates the opportunity for superior returns, as it deters short-sighted capital and allows for the implementation of long-term value creation strategies. Sophisticated investors view this as a strategic advantage, leveraging their patience to capture premiums that are inaccessible to those needing constant liquidity. Integrating alternative assets strategically into your portfolio is not merely about adding new investment types. It's about constructing a more resilient and robust financial fortress. By diversifying beyond the inherent correlations of public markets, you create multiple independent engines for growth, each operating on its own cycle and driven by distinct factors. This structural resilience ensures that your overall wealth trajectory is less susceptible to the whims of any single market or economic downturn, providing a smoother, more predictable path towards your $100 million objective. It's about building a portfolio that thrives not just in bull markets, but one that possesses the fortitude to endure and capitalize on periods of volatility and uncertainty, turning potential headwinds into strategic advantages. The art of effective diversification within the alternative asset landscape lies not just in acquiring these assets, but in their judicious allocation and ongoing management. A scattergun approach, indiscriminately investing in every private deal that crosses your path, is a recipe for disaster. Instead, a thoughtful strategy involves understanding how each alternative asset class complements the others and contributes to the overall portfolio's risk-return profile. This means carefully balancing illiquidity, sector exposure, geographic focus, and manager quality, ensuring that your allocation aligns precisely with your long-term wealth objectives and risk tolerance. It's a dynamic process requiring regular review and adjustment, much like a master craftsman continually refines their masterpiece, ensuring every component serves its ultimate purpose. Ultimately, the journey to becoming an ultra-high net worth individual is paved with decisions that transcend conventional financial advice. Moving beyond the comfort zone of traditional assets and embracing the strategic opportunities presented by private equity, venture capital, and sophisticated real estate investments is not just an option, it is a fundamental imperative. This expanded diversification is the hallmark of truly successful wealth creators, enabling them to capture disproportionate returns, mitigate systemic risks more effectively, and build a legacy of wealth that endures. As we delve deeper into specific alternative asset classes in the following chapters, remember that this foundational shift in perspective is the crucial first step toward unlocking your full potential for financial mastery. Private equity and venture capital deep dive. For those genuinely committed to transcending mere financial comfort and forging generational wealth, the traditional investment landscape, while essential, often presents limitations. Public markets, with their daily fluctuations and broad accessibility, are undeniably important, but the true frontier of exponential growth and strategic advantage frequently lies beyond their immediate reach. This is precisely where private equity and venture capital emerge as indispensable tools within the playbook of the ultra-wealthy, offering unique access to value creation mechanisms that are simply unavailable to the average investor. These sophisticated avenues are not merely alternative assets. They are active partnerships in the growth and transformation of companies, demanding a deeper understanding and a more strategic commitment than conventional holdings. Mastering these domains is a critical differentiator, enabling an investor to tap into concentrated opportunities for outsized returns and to actively shape the future economic landscape. They represent a significant leap in investment sophistication, requiring diligence, foresight, and a robust network to navigate effectively. At its core, private equity involves investing directly into private companies or acquiring public companies with the intention of taking them private to enhance their value over a medium to long-term horizon. Unlike the passive ownership characteristic of public stock market investing, private equity firms typically take a controlling or significant stake, allowing them to implement profound operational and strategic changes. These investments are often characterized by substantial capital commitments, with funds usually raised from institutional investors and high-net-worth individuals. The investment thesis centers around identifying undervalued or underperforming companies, injecting capital, expertise, and strategic direction, and ultimately exiting the investment at a significantly higher valuation. This active management model is what differentiates private equity, making it a powerful engine for value creation. The mechanics of a typical private equity deal often involve a leveraged buyout, LBO, where a significant portion of the acquisition cost is financed through debt. This leverage, while amplifying potential returns, also necessitates rigorous due diligence and a clear strategy for operational improvement to service the debt and generate equity value. Once acquired, the PE firm doesn't just sit back, it actively engages with management, often revamping business models, optimizing supply chains, expanding market reach, and streamlining operations. This hands-on approach is crucial for achieving the targeted growth and efficiency gains that will drive the company's valuation upward. The long holding periods, typically 3 to 7 years, allows sufficient time for these transformative strategies to mature and for the market to recognize the enhanced value. The allure of private equity for the ultra-wealthy stems from its potential for superior, often uncorrelated returns compared to public market indices. By investing in private companies, investors can tap into growth stories before they become widely recognized, capturing a significant portion of the value uplift generated through strategic interventions and operational enhancements. Furthermore, private equity investments tend to exhibit lower correlation with public market volatility, offering valuable diversification benefits within a comprehensive portfolio. This ability to generate alpha through active management and proprietary deal flow provides a distinct advantage, positioning private equity as a cornerstone for those aiming to compound wealth aggressively and beyond the reach of ordinary market fluctuations. It's an opportunity to participate in the value creation at a foundational level, rather than merely trading on sentiment. Venture capital, while also focusing on private companies, operates at a different stage of the corporate life cycle, targeting early-stage, high-growth potential businesses. These are often startups poised to disrupt existing industries or create entirely new markets with innovative technologies or business models. Venture capitalists provide crucial seed funding and subsequent rounds of financing, Series A, B, C, etc., to fuel rapid expansion and product development. The inherent risk is significantly higher than in private equity, given the unproven nature of many startups, but the potential for exponential returns from a successful investment can be truly transformative. Beyond capital, VCs bring invaluable strategic guidance, industry connections, and mentorship, acting as true partners in the entrepreneurial journey, helping founders navigate the complex path from concept to commercial viability. The venture capital investment thesis hinges on identifying companies with strong management teams, disruptive intellectual property, scalable business models, and a clear path to market dominance. VCs conduct exhaustive due diligence, scrutinizing everything from the technology's viability to the competitive landscape and the founder's vision. They are essentially betting on future potential, often investing in companies that are pre-revenue or in their nascent stages, relying heavily on qualitative assessments and forward-looking projections. Given the high failure rate of startups, venture capital firms typically build a diversified portfolio, understanding that a few outlier successes will ultimately drive the fund's overall returns, exemplifying the power law distribution inherent in this asset class. This requires a sharp eye for innovation and an unwavering conviction in the chosen teams. The unique risk-reward profile of venture capital is a defining characteristic, making it both exhilarating and demanding. While the vast majority of startups will not achieve significant success, a single successful investment can generate returns that dwarf those from an entire portfolio of conventional assets. This hit-driven nature means that patience is not just a virtue but a necessity, as the journey from initial investment to a potential exit can span a decade or more. Furthermore, venture capital investments are highly illiquid, with no immediate market for selling shares, locking up capital for extended periods. This requires investors to have a robust liquidity profile and a long-term perspective, understanding that the pursuit of groundbreaking innovation comes with inherent volatility and a substantial commitment of capital and time. Gaining access to top-tier private equity and venture capital funds is inherently exclusive, often requiring substantial minimum investments that can range from millions to tens of millions of dollars. The primary access point for eligible investors is typically through limited partnership (LP) commitments to specific funds managed by general partners (GPs). These funds are usually oversubscribed, meaning that even with the capital, entry is not guaranteed and often depends on pre-existing relationships and a strong reputation within the investment community. Sophisticated investors may also explore co-investment opportunities alongside a fund or participate in fund-of-funds structures, which offer diversification across multiple underlying PE/VC funds. Navigating this landscape requires not only significant capital, but also a well-cultivated network and a clear understanding of the intricate dynamics of private markets. The value proposition offered by private equity and venture capital extends far beyond merely providing capital. It encompasses a profound strategic partnership. PE firms bring not only financial resources, but also deep operational expertise, extensive industry networks, and a disciplined approach to value creation, often appointing board members who actively guide the company. Similarly, VCs act as strategic advisors, connecting startups with talent, customers, and follow-on investors, leveraging their experience to accelerate growth and mitigate early-stage risks. This hands-on involvement fundamentally differentiates private market investing from passive public market exposure, as investors actively contribute to shaping the company's trajectory and enhancing its intrinsic worth. It's an investment in human capital and strategic execution as much as it is in the underlying assets. Integrating private equity and venture capital effectively into a broader wealth-building strategy demands a thoughtful and disciplined allocation approach. These alternative assets should be viewed as complementary components, designed to enhance diversification and provide exposure to distinct return drivers, rather than as replacements for traditional liquid assets. Given their liquid nature and long investment horizons, it's crucial to align commitments with your overall liquidity needs and risk tolerance. Many sophisticated investors adopt a staggered approach, making commitments to new funds over several years to smooth out capital calls and manage vintage year risk. This strategic layering ensures a continuous flow of capital into promising opportunities while maintaining a balanced and resilient overall portfolio structure, essential for long-term compounding. The success of private market investments hinges almost entirely on the selection of exceptional fund managers, making due diligence on general partners an absolutely critical undertaking. Investors must meticulously evaluate a GP's track record, scrutinizing not just headline returns, but also consistency across multiple funds, the composition of the investment team, and the clarity of their investment strategy. Understanding the fee structure, including management fees and carried interest, is paramount to ensuring alignment of interests between LPs and GPs. Beyond quantitative metrics, qualitative factors such as team culture, transparency in reporting, and the GP's commitment to responsible investment practices play a significant role in long-term success. Investing in private equity or venture capital is ultimately an investment in the human capital and proven execution capabilities of the fund manager. A key, often understated aspect of excelling in alternative investing is possessing a robust behavioral edge. The long holding periods, illiquidity, and the inherent volatility of private markets demand immense patience and an unwavering conviction in one's investment thesis. Unlike public markets, where daily price signals can trigger emotional responses, private market investors must remain disciplined through periods of limited information and potential paper losses, trusting in the long-term value creation process. Cultivating independent thinking, resisting herd mentality, and maintaining a rational perspective during economic downturns are crucial. This psychological fortitude allows investors to capitalize on opportunities when others are retreating, ensuring that strategic foresight translates into tangible wealth accumulation over the decades. Navigating various economic cycles is another arena where private equity and venture capital can demonstrate their unique resilience and opportunity. During economic downturns, private equity firms often find attractive opportunities to acquire distressed assets or undervalued companies at more favorable valuations, setting the stage for significant returns when the economy recovers. Similarly, venture capital can identify and back disruptive innovations that emerge or accelerate during periods of economic transformation, creating entirely new markets. While public markets may react with immediate volatility, the longer-term perspective of private capital allows for strategic deployment of funds, often counter-cyclically, to capitalize on shifts that will define the next economic era. This makes them a robust component for a portfolio designed to thrive across diverse market conditions. The culmination of any private equity or venture capital investment strategy is the carefully orchestrated exit, which is when the value created over years is finally realized. For private equity, common exit avenues include initial public offerings, IPOs, strategic sales to larger corporations, or secondary buyouts by other PE firms. Venture capital exits typically involve an acquisition by a larger company, which often seeks to integrate the startup's technology or team, or, for the most successful ventures, an IPO. Timing the exit optimally is a critical skill, requiring keen market insight and strategic finesse from the fund managers to maximize returns for their limited partners. The exit is not merely a transaction, it is the ultimate validation of the investment thesis and the successful execution of the value creation plan. Looking ahead, the landscape of private markets is continuously evolving, marked by increasing institutionalization and a blurring of lines between traditional private equity and venture capital. The rise of growth equity, for instance, bridges the gap, targeting mature startups that are beyond early stage but not yet ready for an IPO. Global expansion is also a significant trend, with private capital increasingly flowing into emerging markets and specialized sectors worldwide. For the sophisticated investor, staying abreast of these developments, understanding new fund structures, and adapting to emerging investment themes is paramount. The private markets represent a dynamic and ever-expanding frontier for wealth creation, demanding continuous learning and strategic agility to capture the most compelling opportunities. Ultimately, private equity and venture capital are far more than just alternative investments. They are foundational pillars within the architectural blueprint for building generational wealth. They offer a unique pathway to participate in and actively shape the most significant growth stories of our time, delivering returns that can profoundly accelerate the journey to the ultra-high net worth bracket. Embracing these sophisticated asset classes demands not only substantial capital, but also a commitment to rigorous due diligence, a deep understanding of market dynamics, and the cultivation of an expansive, influential network. For those aspiring to achieve financial mastery and leave an indelible legacy, integrating private equity and venture capital into your strategic playbook is not merely an option. It is an imperative, a decisive step towards achieving that aspirational $100 million mark and beyond. Real estate as a wealth-building engine. While private equity and venture capital offer compelling avenues for exponential growth, real estate stands as another formidable, often more tangible engine for wealth creation within the ultra-high net worth portfolio. It's a foundational asset class that, when approached strategically, moves far beyond merely owning a home or a small rental property. It becomes a sophisticated mechanism for generating substantial cash flow, capital appreciation, and significant tax advantages. For those aiming to build generational wealth, understanding real estate not just as a physical asset, but as a dynamic financial instrument is absolutely crucial. This perspective shifts the focus from simple landlord-tenant dynamics to complex investment theses, market cycle analysis, and strategic capital deployment. The goal here is not just to participate in the real estate market, but to master its intricate levers to accelerate your journey toward the $100 million benchmark and beyond. It requires a disciplined approach, an eye for latent value, and a willingness to engage with both its immense potential and its inherent complexities. Unlike the often illiquid and high-risk propositions of early-stage startups, real estate offers a unique blend of stability, leverage, and inflation hedging, making it an indispensable component of a diversified wealth strategy. Its inherent tangibility provides a sense of security that purely digital or equity-based assets sometimes lack. Yet, its financial mechanics are anything but simplistic. We are not discussing the speculative flip of a single-family home, but rather the strategic acquisition and development of income-producing assets across various sectors. Think multifamily complexes, industrial warehouses, specialized healthcare facilities, or well-located commercial properties with long-term, creditworthy tenants. Each of these segments presents distinct risk profiles, return expectations, and management complexities, demanding a nuanced understanding to extract maximum value. The discerning investor recognizes that real estate's true power lies in its ability to generate multiple streams of profit simultaneously, transforming raw land or existing structures into cash-generating machines. One of real estate's most compelling attributes is its capacity for strategic leverage, a concept that allows investors to control substantial assets with a comparatively smaller amount of upfront capital. This isn't about reckless borrowing, but rather the intelligent deployment of debt to amplify returns on equity, provided the asset's cash flow can comfortably service the debt obligations. A well-structured loan can dramatically enhance your internal rate of return (IRR) on a profitable venture, turning a solid investment into an exceptional one. However, this powerful tool is a double-edged sword. Excessive or poorly managed leverage can magnify losses just as quickly as it amplifies gains during market downturns. The sophisticated investor understands the delicate balance, meticulously analyzing debt-to-equity ratios, debt service coverage ratios, and the overall cost of capital against projected property performance. It's about using other people's money wisely, not wantonly, to expand your portfolio's reach and impact. Beyond capital appreciation, the consistent cash flow generated by income-producing properties forms the bedrock of real estate's wealth-building appeal. This steady stream of revenue, often net of operating expenses and debt service, provides a predictable income stream that can be reinvested, used to fund other ventures, or simply enjoyed as passive income. Commercial properties, particularly those with triple net (NNN) leases, where tenants cover taxes, insurance, and maintenance, exemplify this model, offering stable, predictable returns with minimal landlord involvement. Multifamily assets, when managed efficiently, also provide robust cash flow, often with built-in rent growth mechanisms that outpace inflation. The ability to generate substantial recurring cash flow frees up capital, reduces reliance on capital gains, and provides a resilient financial buffer against market volatility. This focus on strong, sustainable cash flow is a hallmark of truly successful real estate investors. The inherent inflation hedging qualities of real estate further solidify its position as a core asset for long-term wealth preservation and growth. As the cost of living and goods increases, so too typically do property values and rental rates, allowing real estate assets to maintain or even enhance their purchasing power over time. Unlike fixed income investments, which are eroded by inflation, real estate often adjusts upwards, providing a natural defense against economic shifts. This isn't a guarantee, of course, but a historical pattern that makes real estate particularly attractive during periods of economic uncertainty or rising prices. Savvy investors understand that their real estate portfolio not only generates current income and appreciates in value, but also acts as a robust shield against the invisible tax of inflation, preserving the hard-won value of their capital for future generations. Furthermore, the tax advantages associated with real estate ownership are substantial and often overlooked by less experienced investors. Depreciation, for instance, allows owners to deduct a portion of the property's value each year, effectively reducing taxable income even if the property is appreciating in market value. This non-cash expense can significantly lower an investor's tax liability, enhancing net returns. Moreover, the 1031 exchange provision allows investors to defer capital gains taxes on the sale of an investment property if the proceeds are reinvested into a like-kind property within specific timeframes. This powerful tool enables continuous portfolio growth without the drag of immediate taxation, facilitating a compounding effect that can accelerate wealth accumulation dramatically. Understanding and strategically utilizing these tax codes is not merely a bonus. It is a fundamental component of advanced real estate investment strategy. The journey to $100 million through real estate often involves moving beyond simple buy and hold strategies to encompass more active and complex approaches, such as development. Property development, while carrying higher risk, offers the potential for significantly higher returns by creating value from the ground up or through extensive renovation and repositioning. This involves identifying undervalued land or underperforming assets, securing entitlements, managing construction, and ultimately bringing a new or revitalized product to market. It demands a keen understanding of zoning laws, construction costs, market demand, and project financing. Successful developers are master orchestrators, bringing together architects, contractors, lenders, and brokers to transform vision into tangible, revenue-generating assets. This active participation in value creation is where some of the most substantial real estate fortunes are forged, requiring both vision and meticulous execution. For those who prefer a more passive approach or wish to diversify across a broader range of real estate assets without direct management, vehicles like real estate investment trusts, REITs, and private equity real estate funds offer compelling alternatives. REITs, which trade like stocks on major exchanges, allow investors to own a piece of large, professionally managed portfolios of income-producing properties, providing liquidity and diversification. Private equity real estate funds, conversely, pool capital from accredited investors to acquire, develop, or manage a portfolio of properties, often focusing on specific sectors or strategies. While these options offer different levels of control and liquidity, they both provide exposure to the real estate market's benefits without the operational burden of direct ownership. Choosing the right vehicle depends on an investor's risk appetite, liquidity needs, and desired level of involvement, but all can be powerful components of a comprehensive real estate strategy. Navigating real estate market cycles is paramount for maximizing returns and mitigating risk. Real estate is inherently cyclical, experiencing periods of boom, bust, recovery, and expansion, driven by economic factors, interest rates, population shifts, and local supply-demand dynamics. The astute investor doesn't merely react to these cycles, but anticipates them, positioning their portfolio to capitalize on opportunities and fortify against downturns. Buying during periods of distress, when others are selling, and then holding through a recovery can yield extraordinary returns. Conversely, understanding when a market is overheated and adjusting one's strategy, perhaps by selling non-core assets or tightening lending standards, is equally vital. This requires rigorous market analysis, understanding macroeconomic trends, and often the courage to go against prevailing sentiment. Mastering these cycles is a hallmark of sophisticated real estate investment. Due diligence forms the bedrock of any successful real estate venture, especially when dealing with high-value commercial or development projects. This meticulous investigation goes far beyond a cursory glance at financial statements. It involves a deep dive into every aspect of a property's physical condition, legal standing, environmental risks, and financial projections. From reviewing leases and tenant creditworthiness to commissioning structural surveys, environmental assessments, and title searches, every detail matters. Understanding local zoning ordinances, future development plans, and infrastructure projects can uncover both hidden liabilities and immense opportunities. A thorough due diligence process minimizes unforeseen risks, validates investment assumptions, and ensures that the acquisition or development aligns perfectly with your strategic objectives. Skipping or rushing this critical phase is a common pitfall that can lead to catastrophic financial consequences, underscoring its non-negotiable importance. Building a $100 million real estate portfolio is not just about accumulating properties. It's about strategically curating a diverse collection of assets that work in concert to achieve specific financial goals. This means diversifying not only by property type, e.g., industrial, multifamily, retail, but also by geography, tenant base, and risk profile. A balanced portfolio might include stable, cash-flowing assets providing consistent income alongside opportunistic development projects offering higher growth potential. Spreading investments across different markets mitigates local economic downturns, while a varied tenant roster reduces reliance on any single industry. This layered approach to diversification ensures resilience, provides multiple avenues for growth, and smooths out the inevitable fluctuations within any single real estate segment. It's a sophisticated portfolio management strategy that mirrors the diversification principles applied to other asset classes, but with the unique characteristics of real estate in mind. Ultimately, real estate, when wielded with precision and foresight, transforms into a powerful wealth-building engine capable of propelling you towards and beyond the $100 million mark. Its unique combination of leverage, cash flow generation, appreciation potential, tax advantages, and inflation hedging creates a multifaceted opportunity that few other asset classes can match. However, its immense power comes with an equally significant demand for knowledge, discipline, and strategic execution. It requires a commitment to continuous learning, a robust understanding of market dynamics, and a willingness to engage in meticulous due diligence. For the ambitious investor, real estate is not merely a passive investment, it is an active pursuit of value creation, a strategic game played on a grand scale, and an indispensable pillar in the architecture of enduring wealth. The journey requires not just capital, but also intellectual rigor and an unwavering resolve to master its intricate mechanisms. Understanding and managing financial risk. For those navigating the stratospheric ascent towards the $100 mark, understanding and managing financial risk transcends the rudimentary principles taught to nascent investors. This advanced perspective views risk not merely as a potential for loss, but as a multidimensional variable intrinsically linked to the pursuit of extraordinary wealth. It is an inherent, often desirable component of ambitious wealth creation, demanding a sophisticated, calculated approach rather than blanket avoidance. The adept investor recognizes that true mastery lies in discerning the nuanced facets of risk, transforming it from a looming threat into a measurable, manageable, and even opportunistic element. This involves a deliberate embrace of calculated exposure, ensuring that every risk taken aligns strategically with the overarching objectives of generational wealth building. Ultimately, the goal is not to eliminate risk entirely, which would stifle growth, but to optimize its deployment for maximum return while preserving capital. This nuanced understanding forms the bedrock of an enduring financial legacy. Effective risk management begins with a precise differentiation of the various types of financial exposures inherent in a complex portfolio. Beyond the commonly cited market risk, sophisticated investors must contend with credit risk, operational risk, liquidity risk, and even geopolitical or regulatory risks. Market risk encompasses volatility, systemic events, and broader economic shifts that can impact all asset classes, demanding keen macroeconomic foresight. Credit risk extends beyond simple loan defaults to include counterparty risk in intricate private deals or bespoke lending arrangements, requiring meticulous due diligence. Operational risk, often underestimated, involves internal failures, technological disruptions, and human error, which can severely compromise financial integrity. Grasping these distinct categories is the crucial first step toward constructing a robust and resilient wealth strategy, as each demands a tailored framework for assessment and mitigation. Delving deeper into market risk for the ultra-high net worth individual reveals complexities far beyond public stock fluctuations. This encompasses not only the volatility of listed securities, but also the intricate valuation dynamics of private market holdings, sector-specific downturns, and broader macroeconomic shifts. Consider the pervasive impact of interest rate fluctuations on real estate portfolios, or the subtle erosion of value from currency risk in international investments. Systemic risks, such as global pandemics or significant policy reversals, possess the power to ripple across all asset classes, fundamentally altering market conditions. Sophisticated investors dedicate substantial resources to analyzing these macro trends, anticipating their potential impact on diverse holdings, and proactively adjusting their allocations. True market risk management is about foresight and strategic positioning, not merely reacting to daily headlines, enabling a more resilient portfolio structure. Credit risk, in the context of advanced wealth strategies, moves far beyond the simple assessment of a borrower's ability to repay. For those engaged in private debt, venture lending, or structured finance, it involves a granular evaluation of a counterparty's financial health, operational stability, and industry position. Due diligence becomes paramount, scrutinizing not just balance sheets, but also management quality, cash flow projections, and the robustness of legal covenants. Understanding the interplay of collateral, subordination, and various protective clauses within bespoke credit instruments is essential for safeguarding capital. For the ultra-wealthy, who often directly participate in debt financing, diversifying across different borrowers, industries, and geographic regions is crucial to mitigate concentration risk. This proactive and detailed approach to credit assessment is vital in preserving capital within higher-yielding, less liquid debt opportunities. Operational risk, though less visible than market volatility, represents a significant and potentially devastating threat to substantial wealth. This category encompasses internal process failures, system breakdowns, human error, fraud, and the increasingly prevalent danger of cybersecurity breaches. For entrepreneurial ventures within a portfolio, it can manifest as supply chain disruptions, regulatory noncompliance, or intellectual property theft. Safeguarding against these insidious risks demands robust internal controls, rigorous independent audits, and a culture of strong governance across all entities. Cybersecurity, no longer confined to IT departments, has become a fundamental financial risk, necessitating cutting-edge defenses to protect sensitive data and financial assets. A proactive stance on operational resilience ensures business continuity, protecting both capital and the invaluable reputation built over years of strategic endeavor. The management of liquidity risk is particularly critical for a playbook emphasizing private equity, venture capital, and real estate, assets inherently characterized by their illiquidity. These investments cannot be swiftly converted to cash without potentially incurring significant discounts, posing a substantial challenge if immediate capital is required. The danger lies in being forced into a fire sale during an unfavorable market, thereby eroding long-term value. Therefore, maintaining sufficient and liquid reserves, establishing flexible credit lines against illiquid holdings, and meticulously understanding fund lockup periods and redemption gates are paramount. Strategic planning for future capital calls and investment commitments becomes an ongoing exercise in balancing the portfolio with a judicious mix of both liquid and illiquid assets. This disciplined approach to liquidity management is essential for preventing forced sales and preserving the integrity of a high net worth portfolio. Beyond internal financial dynamics, geopolitical and regulatory risks can profoundly impact even the most diversified global portfolios. These external forces include trade wars, international sanctions, political instability in key regions, and unpredictable shifts in tax laws or environmental regulations. Investing across borders introduces additional layers of complexity, such as currency controls, the risk of asset expropriation, and varying legal frameworks. Astute investors must maintain a vigilant watch on the evolving regulatory landscape in every jurisdiction where capital is deployed, often engaging with policy advisors and legal experts to anticipate shifts. Diversifying across politically stable regimes and economically robust blocs helps mitigate these macro-level vulnerabilities. These risks often materialize as sudden, unpredictable shocks, making proactive scenario planning an indispensable tool for preparing the portfolio for potential disruptions and maintaining its resilience. At the heart of superior financial risk management lies a refined mindset that transcends conventional fear-based reactions, shifting instead to strategic assessment. This approach views risk management not as an exercise in avoidance, but as a continuous, iterative process of taking intelligent, calculated risks that align with long-term objectives. It demands unwavering emotional discipline, enabling investors to resist the urge for panic sales during market downturns or irrational exuberance during speculative booms. Cultivating a culture of critical thinking, questioning assumptions, and understanding one's true risk tolerance and capacity are foundational. The wealthiest individuals recognize that calculated risks, deeply understood and meticulously managed, are the very engines of exponential growth and legacy building. This involves a profound grasp of probabilities, potential outcomes, and the courage to act decisively when others hesitate. Moving beyond qualitative assessments, the sophisticated investor employs quantitative tools to measure and model financial risk with precision. Methodologies like value at risk, VR, stress testing, and comprehensive scenario analysis provide tangible metrics for potential portfolio losses under various conditions. For public market assets, understanding standard deviation, beta, and alpha offers insights into volatility and performance relative to benchmarks. For private and illiquid assets, comparable transaction analysis, discounted cash flow (DCF) models, and sensitivity analysis become crucial for projecting potential outcomes. Developing sophisticated proprietary models that simulate a wide range of future market conditions, often incorporating Monte Carlo simulations, allows for a more objective and data-driven basis for critical investment decisions. While acknowledging the inherent limitations of historical data in predicting extreme events, these quantitative frameworks offer an indispensable layer of analytical rigor. Diversification remains a foundational pillar of risk management. Yet, for the ultra wealthy, its application extends far beyond the simplistic allocation between stocks and bonds. This advanced strategy involves true diversification across distinct asset classes, including private equity, venture capital, real estate, hedge funds, and alternative investments like commodities or infrastructure. Crucially, it also encompasses geographic diversification, sector-specific location, and vintage year diversification for fund investments, which smooths out market entry timing. A deep understanding of correlation analysis is vital, allowing investors to assess how different assets move in relation to each other, aiming for truly uncorrelated holdings that provide genuine portfolio protection. The objective is to avoid diversification, spreading assets too thinly without adding genuine value, and instead build a robust, resilient portfolio capable of weathering shocks from any single point of failure, preserving capital through market cycles. Advanced risk mitigation often necessitates the strategic deployment of hedging and insurance strategies, providing targeted protection against specific vulnerabilities. This includes utilizing derivatives such as options, futures, and swaps to hedge against market volatility, currency fluctuations, or interest rate movements. Tail risk hedging, specifically designed to protect against extreme, low-probability market events, becomes a critical component for safeguarding substantial capital. Furthermore, specialized insurance policies covering areas like directors' and officers' liability, cyber risk, or key person insurance offer crucial layers of protection against operational and legal exposures. A thorough cost-benefit analysis is essential for any hedging strategy, as these instruments are not without expense or complexity. These sophisticated tools are employed by astute investors to fine-tune their risk profiles, offering precise safeguards against identifiable threats. Effective risk management is an inherently dynamic and continuous process, demanding constant vigilance and adaptability rather than a static, one-time exercise. This necessitates regular comprehensive portfolio reviews, a persistent reevaluation of all risk exposures, and a willingness to adapt to evolving market conditions, economic cycles, and even personal financial circumstances. Establishing clear trigger points for rebalancing, de-risking specific positions, or seizing new opportunities is crucial for maintaining strategic alignment. Collaborating closely with a multidisciplinary team of advisors, including financial planners, legal counsel, and tax experts, ensures that the investment strategy remains informed and compliant. The financial landscape is perpetually shifting, and an agile, proactive approach to risk adjustment is the unmistakable hallmark of enduring wealth preservation and growth. Beyond standard risk models, sophisticated investors engage in rigorous scenario planning and stress testing to anticipate the impact of extreme, unforeseen events. This involves envisioning adverse what-if scenarios, such as a dramatic spike in interest rates, the collapse of a key industry, or a severe global recession. The goal is to simulate the potential impact of these black swan events on the entire portfolio, identifying latent vulnerabilities that might not be apparent under normal market conditions. Developing comprehensive contingency plans for various worst-case outcomes allows for proactive preparation, fostering a deeper understanding of the portfolio's resilience under duress. This forward-looking approach ensures that the wealth structure is not only robust but also anti-fragile, capable of withstanding and even benefiting from systemic shocks. For private investments, robust governance and meticulous due diligence serve as the frontline defense against undue risk. This involves an exhaustive investigation of management teams, scrutinizing business models, validating legal structures, and thoroughly auditing financial statements before capital deployment. Understanding the various exit strategies and potential liquidity events for private holdings is also paramount to managing illiquidity risk. Post-investment, active board participation, rigorous performance monitoring, and ensuring alignment of incentives between investors and management are critical for ongoing oversight. When investing in funds, a deep dive into fund managers' track records, their investment theses, and the transparency of their fee structures is indispensable. Strong governance protocols minimize operational and strategic risks within illiquid holdings, assuring that capital is deployed and managed with the highest degree of care and fiduciary responsibility. Synthesizing these elements, building a truly robust risk framework involves a systematic process to identify, measure, monitor, mitigate, and report on all material risks. This necessitates establishing clear, comprehensive risk policies and guidelines that govern every investment decision across the entire portfolio. Assigning explicit responsibility for risk oversight, often within a dedicated family office or investment committee, ensures accountability and consistent application of these policies. Regular risk committee meetings are essential for reviewing current exposures, assessing the effectiveness of mitigation strategies, and making timely adjustments. By integrating risk considerations into the very fabric of every investment decision, a structured approach provides consistency, discipline, and transparency. A well-defined framework is not merely a formality. It is an indispensable blueprint for managing multi-generational wealth with unwavering precision and foresight. Finally, the most profound understanding of risk transforms it from a mere threat into a powerful identifier of opportunity. Periods of heightened market volatility, often shunned by the fearful, frequently present the most compelling entry points for patient, well-capitalized investors. A deep, analytical grasp of true risk allows for intelligent contracyclical investing, enabling the acquisition of distressed assets or undervalued opportunities during market downturns. This strategic advantage hinges on having a strong, liquid balance sheet and the intellectual clarity to discern genuine value amidst widespread panic. Effective risk management provides the stability and insight necessary to seize these transient moments, turning potential pitfalls into pathways for achieving superior, outsized returns that propel a portfolio towards its $100 million objective. The art of value investing and asset allocation. For those aspiring to the rarefied air of ultra-high net worth, simply accumulating capital is not enough. The true mastery lies in its intelligent deployment and diligent preservation. This pursuit demands a sophisticated understanding of two foundational pillars: the discerning eye of value investing and the strategic foresight of optimal asset allocation. These are not mere financial buzzwords, but rather deeply ingrained philosophies that guide the decisions of the most successful wealth builders. They represent a departure from speculative gambles, instead favoring a methodical, evidence-based approach to capital growth. Embracing these principles transforms the act of investing from a reactive game into a proactive, long-term endeavor. It requires an investor to think like an owner, not just a trader, meticulously evaluating potential holdings. Ultimately, the synergy between these two disciplines forms the bedrock upon which truly generational wealth is constructed, providing both resilience and exponential growth potential. Without a firm grasp of both, even substantial initial success can prove fleeting in the unpredictable currents of global markets. At its heart, value investing is an elegant yet rigorous philosophy centered on purchasing assets for less than their intrinsic worth. This isn't about chasing fleeting trends or speculating on hot tips, but rather conducting thorough, independent analysis to determine a company's true underlying value, irrespective of its current market price. The legendary Benjamin Graham, often considered the father of value investing, championed the concept of a margin of safety, advocating for buying assets at a significant discount to their estimated intrinsic value. This built-in buffer protects against unforeseen economic downturns or miscalculations in analysis, providing a crucial layer of risk mitigation. It demands immense discipline to ignore the daily gyrations of the market and focus instead on the fundamental health and future earnings power of an enterprise. This contrarian mindset often leads value investors to look for opportunities where others see only distress or disinterest, finding hidden gems amidst market pessimism. True wealth builders understand that patience in waiting for the right price is a virtue that pays dividends over decades. Executing successful value investing requires a deep dive into due diligence, far beyond merely glancing at a stock chart or a company's recent headlines. It necessitates a forensic examination of financial statements, including balance sheets, income statements, and cash flow reports, to truly understand the economic engine powering the business. Beyond the numbers, a value investor meticulously assesses a company's competitive advantages, often referred to as its moat, which protects its profitability from rivals. This involves understanding the industry landscape, the strength of its brand, its technological edge, or its cost efficiencies. Equally critical is evaluating the quality and integrity of the management team, as even the most promising business can falter under poor leadership. This exhaustive research process aims to uncover a business's true economic reality, allowing for an informed estimate of its intrinsic worth and a confident investment decision. Perhaps the most challenging, yet undeniably crucial aspect of value investing is the unwavering commitment to a long-term horizon and the profound patience it demands. Market sentiment can remain irrational for extended periods, and an undervalued asset may not be recognized by the broader market for months or even years. True value investors are not swayed by short-term market noise, quarterly earnings misses, or the latest analyst ratings. Their conviction stems from their own meticulous research and belief in the underlying business. This steadfastness allows them to weather market volatility, viewing downturns not as losses, but as potential opportunities to acquire more high-quality assets at even more attractive prices. The compounding power of returns over decades, rather than months, is the ultimate reward for this disciplined, patient approach. It's about cultivating a mindset that prioritizes fundamental strength over fleeting market popularity. While value investing focuses on selecting individual assets, asset allocation operates at a higher, strategic level, determining how your capital is distributed across different asset classes. For those building generational wealth, this isn't a casual decision, but a meticulously crafted blueprint that dictates the portfolio's overall risk and return characteristics. It's about constructing a resilient financial architecture capable of withstanding various economic climates and market shocks, rather than relying on the performance of a single investment type. The core premise is that different asset classes, such as equities, fixed income, real estate, and alternatives, behave differently under varying economic conditions, offering a natural hedge against volatility. A well-considered asset allocation strategy ensures that your portfolio is diversified not just within an asset class, but strategically across them, optimizing for both growth and stability. This foundational step is arguably more impactful on long-term returns and risk management than individual security selection alone. For the ultra-wealthy, diversification extends far beyond the conventional split between publicly traded stocks and bonds, venturing into a sophisticated array of alternative assets. This expanded universe includes private equity, venture capital, hedge funds, and direct real estate holdings, each offering unique risk-return profiles and often lower correlation to traditional markets. These alternative investments can provide access to growth opportunities not available in public markets, along with the potential for enhanced returns and further portfolio stability. However, they also typically come with higher illiquidity and complexity, demanding a deeper understanding and a longer investment horizon. Integrating these less traditional assets into an allocation strategy requires expert knowledge and significant capital, making it a hallmark of advanced wealth management. It's about building a truly robust and resilient portfolio, not just a broadly diversified one. Asset allocation typically involves two primary approaches, strategic and tactical. Strategic asset allocation establishes a long-term, target mix of asset classes designed to meet specific financial goals and risk tolerance over many years, often decades. This foundational plan remains relatively stable, acting as the bedrock of the portfolio. Tactical asset allocation, on the other hand, involves making short-term, opportunistic adjustments to the strategic allocation based on current market conditions or economic forecasts. These adjustments are usually minor deviations from the long-term targets, aimed at capitalizing on perceived opportunities or mitigating immediate risks. While tactical shifts can enhance returns, they carry higher execution risk and require deep market insight. The majority of a sophisticated investor's focus remains on maintaining the integrity and discipline of their strategic allocation. The balance between these two approaches defines the agility and stability of a high-net-worth portfolio. The development of an effective asset allocation strategy is inherently personal, meticulously tailored to an individual's unique risk tolerance, liquidity needs, and overarching financial goals. There is no one-size-fits-all solution. What works for one ultra-high net worth investor might be entirely inappropriate for another. A younger entrepreneur with significant human capital and a long-time horizon might favor a more aggressive, growth-oriented allocation, heavily weighted towards equities and private investments. Conversely, an investor nearing legacy planning might prioritize capital preservation and income generation, leaning towards more stable, income-producing assets. Understanding your own psychological comfort with market fluctuations and clearly defining your wealth objectives, whether it's funding a family office, philanthropic endeavors, or intergenerational wealth transfer, is paramount in crafting an allocation that truly serves your vision. This deep self-assessment forms the crucial first step in building a personalized financial fortress. Even the most thoughtfully constructed asset allocation strategy requires regular maintenance through a process known as rebalancing. Over time, market movements will inevitably cause the proportions of different asset classes in your portfolio to drift from their original target weights. For instance, a strong bull market might cause your equity holdings to grow significantly, increasing your overall risk exposure beyond your comfort level. Rebalancing involves periodically selling assets that have performed well and buying those that have lagged, bringing the portfolio back to its target allocation. This disciplined approach serves two critical functions. It systematically forces you to buy low and sell high, albeit passively. And more importantly, it ensures your portfolio's risk profile remains aligned with your long-term objectives. Without consistent rebalancing, even a perfectly designed allocation can silently morph into a riskier or less efficient structure, undermining its intended purpose. For those building wealth on a grand scale, the concept of asset allocation must necessarily adopt a global perspective, extending beyond the confines of domestic markets. Limiting investments to a single country or region concentrates risk and potentially forfeits significant growth opportunities available elsewhere. Diversifying across different geographies and economies can provide a crucial layer of stability, as various regions often operate on different economic cycles and are influenced by distinct geopolitical factors. Emerging markets, for example, might offer higher growth potential, while developed markets provide stability and lower volatility. This global outlook also helps mitigate currency risk and reduces the impact of localized economic downturns or policy changes. Accessing a broader universe of investment opportunities is not just about maximizing returns. It's about building a truly resilient portfolio that thrives irrespective of any single nation's fortunes. The true artistry of wealth creation lies in seamlessly integrating the principles of value investing within the framework of a strategic asset allocation. It's not about choosing one over the other, but rather understanding how they complement and enhance each other. Once the broad allocation percentages are determined for equities, fixed income, real estate, and alternatives, value investing becomes the guiding philosophy for selecting the specific assets within each of those categories. For example, within your equity allocation, you would actively seek out fundamentally sound companies trading below their intrinsic value, rather than simply buying market index funds. Similarly, in real estate, you would identify properties or development projects that offer a strong margin of safety and clear upside potential. This synergistic approach ensures that both your overall portfolio structure and your individual holdings are optimized for long-term growth and protection. Even with the most robust analytical frameworks, the human element of investing, specifically behavioral biases, can be a formidable adversary. Both value investing and strategic asset allocation demand a high degree of emotional discipline, often requiring investors to act contrary to prevailing market sentiment. The temptation to chase hot stocks, abandoning value principles, or to panic sell during downturns, derailing asset allocation, is powerful and pervasive. Overconfidence, herd mentality, and loss aversion are just a few of the psychological traps that can derail even the most meticulously planned strategies. Recognizing these inherent biases and developing mechanisms to counteract them, such as strictly adhering to a rebalancing schedule or maintaining a circle of competence in value investing, is absolutely critical. Mastering one's own psychology is, in many ways, the ultimate skill in the art of wealth creation. Navigating the intricate landscape of value investing and sophisticated asset allocation, particularly for substantial wealth, often necessitates the collaboration with experienced financial professionals. An independent, expert advisor can provide invaluable insights, help mitigate behavioral biases, and ensure that your strategies remain aligned with your evolving goals and market conditions. They possess the specialized knowledge to identify unique investment opportunities in private markets, structure complex portfolios efficiently, and manage the intricate tax implications of high net worth investing. Furthermore, a trusted advisor can serve as an objective sounding board, challenging assumptions and providing a disciplined perspective when emotions threaten to cloud judgment. This partnership allows you to focus on your core competencies while entrusting the complexities of wealth management to those who specialize in it. It is crucial to understand that both value investing and asset allocation are not static decisions made once and then forgotten. They are dynamic, evolving processes that require continuous review and adaptation. Economic landscapes shift, market cycles turn, and an individual's financial circumstances and goals inevitably hang over time. What constituted an optimal allocation strategy 5 years ago may not be appropriate today, just as a once undervalued company might now be overvalued. Regular, perhaps annual or semi-annual, assessments of your portfolio's performance, alignment with objectives, and the underlying fundamentals of your holdings are non-negotiable. This iterative process of review, adjustment, and reevaluation ensures that your wealth creation playbook remains relevant, robust, and responsive to the ever-changing global environment. Ultimately, the art of value investing and asset allocation, when skillfully interwoven, forms a powerful synergy for building and preserving significant generational wealth. Value investing provides the disciplined framework for identifying and acquiring high-quality assets at attractive prices, ensuring that every dollar invested works harder. Asset allocation, on the other hand, constructs the overarching strategic architecture, diversifying risk and optimizing for long-term growth across diverse market conditions. Together, these two pillars empower investors to transcend the noise of short-term speculation, fostering a methodical, patient, and profoundly intelligent approach to capital stewardship. Embracing this dual mastery is not merely about accumulating more money. It's about establishing an enduring financial legacy, built on principles of prudence, foresight, and unyielding discipline. This playbook is your guide to mastering these essential arts.